Hello and welcome. If the D774 OA exam has been on your mind and you're wondering how to approach it, then you're in the right place. Our website has D774 OA questions and answers, and it won't cost you a thing. OA exams are tough, so everything from guides to practice questions is free. With over 100 plus success stories, we have proven our videos will help you pass your exam on the first attempt. In this video, we will cover questions from accounting definition, accounting branches, internal controls, financial statements, cash flows. So let's get started.
Question 1. A bakery owner ends each month with a shoebox full of receipts, invoices, and payroll records. Her accountant sorts these scattered events into categories, totals them, and produces a report showing the month's profit so the owner can decide whether to raise prices. Which description best captures what accounting has done here? Your options are A. It predicted the bakery's future sales for the coming year. B. It guaranteed the bakery's compliance with all tax laws. C. It organized, analyzed, and communicated financial information to support a decision. D. It removed the need for the bakery to keep any records at all. Which one is it? Pause the video if you need more time. The correct answer is C. It organized, analyzed, and communicated financial information to support a decision. C is correct because accounting is the process of organizing, analyzing, and communicating financial information to support decision making. The accountant took raw historical data and converted it into usable information the owner could act on, which is the three-verb definition in action. A is wrong because accounting works with historical data about events that already happened, and it is limited as a predictive tool because business involves uncertainty. Forecasting future sales is closer to forward-looking managerial planning, not the core definition shown here. B is wrong because regulatory compliance is one purpose of accounting, but the scenario describes turning records into a profit report for a pricing decision, not satisfying tax law. Nothing in the example guarantees legal compliance. D is wrong because the report described is built directly from the kept records. So accounting depends on those records rather than replacing them. Good record keeping is the raw input the accountant organizes. Accounting is best understood as a process with one clear purpose, turning raw financial events into information that people can actually use to make decisions. Let's look at how that process works and why it matters. At its core, accounting does three things. It organizes scattered financial events into sensible categories, analyzes the totals for meaning, and communicates the results in a form others can use. A shoebox of receipts is just data. Accounting turns that data into a story that points toward a decision. The pipeline runs one way. Historical financial data flows in, things that have already happened, and structured information flows out. That's why financial reporting is described as backward-looking, but the output is far more than a pile of numbers. It is information shaped to support a choice. Two purposes sit behind all of this. The first is tracking financial performance, recording revenue, expenses, and profitability over time. The second is ensuring regulatory compliance, meeting legal requirements like paying taxes correctly and following accepted accounting rule sets, such as generally accepted accounting principles. Because everyone follows the same rule set, an investor in one city can read any company's statements and understand them. Accounting is called the language of business precisely because it has agreed rules, just like a spoken language, and different people draw the same meaning from the same words. Question 2. A company's controller prepares a report that follows GAAP, covers the whole business, will be audited, and is issued to investors and lenders every quarter. Which type of accounting does this report represent, and who is its primary audience? Your options are A. Managerial accounting prepared for internal managers. B. Financial accounting prepared for external users. Sir, managerial accounting prepared for outside regulators. D. Tax accounting prepared only for a single agency. Take a second. Which answer would you pick? The correct answer is B. Financial accounting prepared for external users. B is correct because financial accounting follows JAP, presents a broad picture of the whole business, is audited, is issued at set intervals such as quarterly, and serves external users like investors, banks, and regulators. Every feature in the scenario matches financial accounting. A is wrong because managerial accounting serves internal managers, is flexible rather than GAAP bound, is not audited, and is produced whenever managers need it. The audited GAAP-based quarterly report described does not fit managerial accounting. C is wrong because managerial accounting is for internal decision makers, not outside regulators, and it is not governed by GAAP or audited. Pairing managerial accounting with an external audience misstates its purpose. D is wrong because tax accounting is a narrower compliance activity, while the report described is a broad, audited, GAAP-based statement for investors and lenders. The general purpose statements here are not a tax filing for one agency. Accounting splits into two major branches, and understanding what separates them comes down to one core question: who is the information actually for? Every other difference flows from the answer to that question. Financial accounting serves outsiders, investors, banks, and regulators who need to compare and evaluate companies. Managerial accounting serves the people inside the company who are making day-to-day decisions about how to run the business. The differences stack up across 5 dimensions. Financial accounting follows strict JP rules, reports on a fixed schedule, and is audited so outsiders can trust the numbers. Managerial accounting is flexible, produced on demand, and never audited because it stays inside the company. Managerial accounting also differs in scope and orientation. It drills into specifics like units produced or defect rates, freely mixes financial and non-financial data, and uses forward-looking budgets and projections to help managers plan ahead. The clearest way to remember the distinction: financial accounting is external reporting of the past, while managerial accounting is internal decision-making about the future. That single contrast captures the entire framework. Question 3. At a coffee roasting company, the following groups all follow the firm's financial results: the bank that lent it money, the employees who work there, a supplier of green coffee beans, and an investor who owns shares. Which statement about these groups is accurate? Your options are: A. All of them are stakeholders, but only the share-owning investor is also a stockholder. B. All of them are stockholders because they all have an interest in the company. Only the investor is a stakeholder and the others are merely customers. D. The employees and supplier are stockholders while the bank is not. Before I reveal it, which one do you think is right? The correct answer is A. All of them are stakeholders, but only the share-owning investor is also a stockholder. A is correct because a stakeholder is anyone with an interest in the company, while a stockholder is specifically an owner who holds shares. All 4 groups have an interest, so all are stakeholders, but only the share-owning investor is also a stockholder, matching the rule that all stockholders are stakeholders, but not all stakeholders are stockholders. B is wrong because owning an interest does not make someone a stockholder. Only buying shares does. The bank, employees, and supplier care about the firm without owning any stock, so they are stakeholders only. C is wrong because stakeholders include lenders, employees, suppliers, and the community, not just investors. Labeling the others as mere customers ignores the broad definition of a stakeholder. D is wrong because employees and suppliers are stakeholders, not stockholders, because they hold no shares. This choice reverses the relationship between the two terms. These two terms sound nearly identical, but they describe a precise relationship that appears constantly in accounting and finance. Understanding exactly how they fit together will protect you from one of the most common errors on this topic. Picture two circles, one nested inside the other. The large outer circle holds every stakeholder, anyone who cares about the company for any reason. The small inner circle holds only stockholders, people who actually own shares. Every stockholder sits inside that outer circle, but the outer circle stretches far beyond the inner one. A single company can have stakeholders of many kinds: employees whose jobs depend on the firm, suppliers who want a steady buyer, lenders who want repayment, customers, and regulators. Only the last group, stockholders, are also owners. All the others hold a stake without holding a single share. The rule is simple but must be stated in the right direction. All stockholders are stakeholders, true, but reversing it, claiming all stakeholders are stockholders, is false. If you see that reverse claim on an exam, it is wrong every time. Whenever you encounter these terms, return to the nested circles. The small owner's circle always sits inside the large interested party's circle, and the large circle always extends well beyond the small one. Get that picture right, and this topic will not trip you up. Question 4. A furniture maker buys fabric from a textile supplier on terms that let it pay the full amount in 45 days with no interest charged. Separately, it borrows money from a bank to be repaid over 6 years with interest. How should each party be classified? Your options are: A. The supplier is a lender and the bank is a creditor. B. Both the supplier and the bank are creditors. C. Both the supplier and the bank are lenders. D. The supplier is a creditor and the bank is a lender. What's your answer? Commit to one before I continue. The correct answer is D. The supplier is a creditor and the bank is a lender. D is correct because a creditor extends short-term credit, usually 30 to 45 days with no interest, and is typically another business such as a supplier. A lender provides long-term loans over years, charges interest, and is usually a bank, so the supplier is the creditor and the bank is the lender. A is wrong because this reverses the two roles. The short-term, interest-free supplier is the creditor, and the multi-year, interest-bearing bank loan makes the bank the lender. B is wrong because a bank making a 6-year interest-bearing loan fits the definition of a lender, not a creditor. Only the supplier offering short-term, interest-free terms is a creditor. C is wrong because a supplier offering 45-day interest-free terms is a creditor, not a lender. The two arrangements differ in time horizon and interest, so they cannot both be lenders. Both creditors and lenders are owed money by a business, but they differ on 3 clean dimensions that make them easy to tell apart once you know what to look for. A creditor extends short-term credit, typically 30 to 45 days, is usually a supplier, and charges no interest. A lender provides a long-term loan over years, is usually a bank or financial institution, and always charges interest. Think of the flour supplier letting the bakery pay in 30 days. That's a creditor. The same bakery borrowing from a bank to buy a building and repaying with interest over years. That's a lender. Whether a party is a creditor or a lender, both belong to the broader family of capital providers. Before parting with their money, they care about profitability, whether the business earns money, and financial health, whether it's durable enough to keep doing so. When in doubt, apply the time and interest test. Short term with no interest points to a creditor. Long term with interest points to a lender. Those 2 checks resolve nearly every scenario you'll encounter. Question 5. A manufacturer is under pressure to look more profitable than it really is. So its chief financial officer records several large sales to customers who never actually placed orders. inflating the revenue figure. Which method of financial statement fraud is this, and on which statement does it appear? Your options are A. Understating liabilities appearing on the balance sheet. B. Overstating revenue appearing on the income statement. C. Overvaluing assets appearing on the balance sheet. D. Understating expenses appearing on the income statement. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Overstating revenue appearing on the income statement. B is correct because recording sales that were never earned is overstating revenue, which makes the company look more profitable than it is. Revenue is an income statement item, so this fraud appears on the income statement. A is wrong because understating liabilities means hiding debt the company owes, and it appears on the balance sheet. The scenario inflates sales rather than concealing obligations. C is wrong because overvaluing assets means reporting that what the company owns is worth more than it truly is, and it shows up on the balance sheet. Booking fake sales affects revenue, not asset values. D is wrong because understating expenses means hiding costs to make net income look higher, a different income statement manipulation. Here, the fraud adds fake revenue rather than concealing expenses. Financial statement fraud, sometimes called cooking the books, is when a company deliberately uses its financial reports to hide its true condition or conceal illegal transactions. The key word is deliberately. An honest mistake is never fraud. Fraud requires a conscious choice to deceive the people who rely on those numbers. Motives vary widely. A company might want to look more profitable to attract investors, boost its share price, or unlock executive bonuses. It might hide debt from lenders, evade taxes, or bury a transaction that wouldn't survive scrutiny. The common thread is always the same. The statements are being used to mislead. There are 4 primary techniques, each targeting a specific statement. On the income statement, fraudsters overstate revenue by booking sales that were never earned, or understate expenses by hiding costs. Both inflate reported profit. On the balance sheet, they overvalue assets or understate liabilities to make the company look stronger and less risky than it truly is. Because all 4 financial statements are interconnected, fraud rarely stays contained. Overstating revenue inflates net income, which inflates equity, which then distorts the balance sheet. A falsified figure ripples across the statements, and a careful examiner can sometimes spot manipulation by checking whether the statements still agree with one another. One practical habit protects any reader. Always read the notes that accompany the statements. Notes often reveal the assumptions and obligations that headline numbers conceal. A reader who skips them is far easier to deceive. Question 6. An employee notices that one person handles incoming cash, records it in the books, and reconciles the account, so a theft would go undetected. According to the fraud triangle, which element does this weakness and oversight represent? Your options are A. Rationalization, B. Pressure, C. Opportunity, D. Certification. Which would you go with? Lock it in before the reveal. The correct answer is C. Opportunity. C is correct because opportunity is the chance to commit fraud created by weak internal controls. One person controlling cash handling, recording, and reconciliation is exactly the kind of control weakness that opens the door to undetected fraud. A is wrong because rationalization is the mental justification a person uses to excuse fraud, such as telling themselves they will pay it back. The scenario describes a control gap, not a state of mind. B is wrong because pressure is the motivation to commit fraud, often from financial difficulty. The scenario describes the chance to act, not the reason someone feels pushed to do so. D is wrong because certification is not one of the 3 corners of the fraud triangle, which are pressure, opportunity, and rationalization. The weakness described maps to opportunity. The fraud triangle is a model explaining why fraud happens. Its core insight is that three conditions must all be present at the same time for fraud to occur, and removing even one makes fraud far less likely. Those three conditions are pressure, opportunity, and rationalization. Pressure is the motivation, the felt financial or professional need that pushes someone toward dishonesty. Opportunity is the opening created by weak internal controls. Rationalization is the mental justification that makes the wrongdoing feel acceptable to the person committing it. Visually, the model forms a triangle where each corner depends on the others. All three must overlap for fraud to occur. The moment one corner is removed, the triangle collapses, and so does the fraud. Of the three corners, opportunity is the one a business owns. Pressure is often personal and financial, hard for an employer to remove. Rationalization lives inside someone's mind, beyond reach entirely. But opportunity arises from weak internal controls, and those controls can be strengthened. Separating duties, requiring approvals, and conducting audits all work to shrink this corner. The most common mistake is confusing pressure with opportunity. Remember, pressure is the motivation. Opportunity is the chance created by weak controls. And rationalization is the internal justification. Hold those three meanings apart, and the model becomes a powerful tool for both prevention and exam success. Question 7. A public company hires an independent accounting firm that is not on its payroll to examine its financial statements for JARPI compliance and issue an opinion that investors can rely on. Which kind of auditor is this firm providing? Your options are A. An external auditor, B. An internal auditor, C. A government examiner from the SEC, D. A revenue center manager. Don't overthink it. Which one feels right? The correct answer is A. An external auditor. A is correct because an external auditor is an independent professional, often from a CPA firm, who is not an employee of the client and provides an opinion on whether the statements fairly reflect the company's condition under GAAP. Independence and the GAAP opinion are the defining marks of an external auditor. B is wrong because an internal auditor is an employee of the organization who focuses on improving operations and preventing fraud from the inside. The firm described is independent and not on the payroll, which rules out internal auditing. C is wrong because the SEC is a government regulator of securities markets, not a firm a company hires to issue an opinion on its statements. The scenario describes a privately hired accounting firm, not a government examiner. D is wrong because a revenue center manager is a responsibility accounting role focused on generating sales, which has nothing to do with auditing financial statements. The scenario clearly describes an audit engagement. Auditing divides into two distinct roles whose entire contrast flows from one simple question: who employs the auditor? Anchoring on that employment distinction will let you classify each role correctly almost every time. An internal auditor is an employee working from inside the organization, focused on preventing fraud, improving operations, and strengthening controls. An external auditor is an independent professional, typically from a CPA firm, whose job is to deliver a formal, unbiased opinion on the financial statements. Think of the two roles as concentric layers of defense. Internal auditors work continuously from inside, catching weaknesses before they become problems. External auditors stand outside, applying accounting standards to render an independent opinion that investors and regulators can trust. The two roles are complementary, was one preventive and internal, the other confirmatory and independent. A healthy reporting system depends on both. When a scenario describes an independent firm issuing a formal opinion, that is external. When it describes an employee monitoring fraud from within, that is internal. Question 8. A large multinational corporation whose stock trades publicly wants an audit firm with deep experience auditing other publicly traded companies. Which group of firms is it most likely to choose? Your options are A. Enron, WorldCom, and Tyco. B. FASB, the SEC, and the PCAOB. C. Firms holding the CPA, CMA, and CFE credentials. D. The Big Four, namely Deloitte, EY, PwC, and KPMG. Got a guess? Lock it in! The correct answer is D. The Big Four, namely Deloitte, EY, PwC, and KPMG. D is correct because the Big Four, namely Deloitte, PwC, and KPMG, are the largest accounting firms and have the global scale and experience to audit the largest publicly traded multinationals. A giant public company seeking experienced auditors would turn to one of them. Is wrong because Enron, WorldCom, and Tyco are the scandal-ridden companies whose failures triggered reform, not audit firms a company would hire. They are examples of fraud, not auditors. B is wrong because FASB, the SEC, and the PCAOB are standard-setting and regulatory bodies, not audit firms hired by companies. They oversee the system rather than performing client audits. C is wrong because CPA, CMA, and CFE are individual professional certifications, not the names of audit firms. A multinational hires a firm such as one of the Big Four, not a set of credentials. The Big Four accounting firms dominate the world of external auditing, and a famous corporate scandal reshaped the rules that govern them. Understanding both helps connect firm names, fraud methods, and reform legislation. The Big Four, Deloitte, Ernst & Young, PricewaterhouseCoopers, and KPMG, are the only firms with the global offices and public company experience needed to audit the largest multinationals. When a scenario describes a massive, publicly traded corporation shopping for an auditor, the answer is one of these four. Enron concealed enormous obligations while reporting inflated profits, understating liabilities and overstating profitability at the same time. Its external auditor, Arthur Andersen, was supposed to be the independent guardian of accurate reporting but failed that role entirely, bringing down both the company and the firm. Arthur Andersen's collapse alongside Enron shook confidence in the entire auditing profession. The scandal, joined by frauds at WorldCom and Tyco, demonstrated that without genuine auditor independence, the last line of defense disappears. The government responded with the Sarbanes-Oxley Act of 2000, which introduced stronger internal controls, mandatory auditor independence, and a new oversight board, the PCAOB, to watch over the auditors themselves. Enron is the scandal. Sarbanes-Oxley is the reform it triggered. Question 9. A manager claims that because the company installed a strong internal control system, the risk of fraud and loss has been completely eliminated. Why is this claim incorrect? Your options are A. Internal controls have no effect on the risk of loss at all. B. Internal controls reduce the risk of loss but cannot eliminate it entirely. C. Internal controls increase the risk of loss by adding complexity. D. Internal controls only matter for managerial accounting reports. Which one is it? Pause the video if you need more time. The correct answer is B. Internal control reduce the risk of loss but cannot eliminate it entirely. B is correct because a properly designed internal control system reduces the risk of loss but never drives it to zero, because determined people could collude or an unforeseen gap could be exploited. The correct verb is always reduce, not eliminate or guarantee. A is wrong because internal controls clearly do affect risk, since their entire purpose is to lower the chance and impact of error, theft, and fraud. Saying they have no effect contradicts why companies build them. C is wrong because internal controls are designed to lower risk, not raise it. While no system is perfect, the controls reduce exposure rather than increase it. D is wrong because internal controls protect assets and the accuracy of all financial records, not just managerial reports. They are central to reliable financial accounting and to safeguarding cash and inventory. Internal controls are the systems, policies, and procedures organizations use to manage risk and defend against fraud and error. They are the organized defense that keeps a business honest and accurate, the locks, checklists, and review routines that protect daily operations. A formal internal control system exists to deliver 4 assurances: protecting assets, ensuring accurate records, keeping operations efficient, and making sure employees follow the rules. Controls fight fraud in 3 concrete ways. They ensure financial accuracy by preventing false reporting. They protect assets from theft and unauthorized access. And they detect suspicious activity before problems escalate. The connection to the fraud triangle is direct. The opportunity corner comes from weak internal controls, and it is the corner a business can most directly attack. Strengthening control shrinks opportunity, lowering the overall likelihood of fraud even when pressure and rationalization cannot be addressed. One principle limits what any control system can promise. A well-designed system will reduce the risk of loss, not eliminate it. No system is perfect. Collusion or unforeseen gaps can still be exploited. And under the Sarbanes-Oxley Act, management bears final responsibility for maintaining these controls. That obligation rests with leadership, not auditors. Question 10. While preparing a bank reconciliation, an accountant finds a check the company wrote and already deducted from its own books, but the recipient has not yet cashed it, so the bank has not removed it. What is this item called, and which balance must be adjusted for it? Your options are A. An outstanding check, which adjusts the bank balance. B. A deposit in transit, which adjusts the bank balance. C. A non-sufficient funds check, which adjusts the book balance. D. A bank service fee, which adjusts the book balance. Take a second. Which answer would you pick? The correct answer is A. An outstanding check which adjusts the bank balance. A is correct because an outstanding check is one the company has written and subtracted from its records, but the payee has not yet cashed, so the bank has not deducted it. Because the bank does not yet know about it, the adjustment is made by subtracting it from the bank balance. B is wrong because A, deposit in transit, is money the company recorded but the bank has not yet posted, and although it also adjusts the bank side, it is added rather than subtracted. The scenario describes a check not yet cashed, not a pending deposit. C is wrong because A, non-sufficient funds check, is a bounce customer check that adjusts the company's book balance, not the bank side. The item described is a check the company itself wrote, not a returned deposit. D is wrong because a bank service fee is a charge the bank deducted that the company has not recorded, so it adjusts the book balance. The scenario involves an uncashed company check, which is an outstanding check on the bank side. A bank reconciliation explains why companies' cash records and the bank's records show different balances. The difference is almost never an error, it's a timing problem. Some transactions have been recorded by one party but not yet by the other. There are 4 common timing items. Deposits in transit and outstanding checks are things the company knows, but the bank hasn't recorded yet. So they adjust the bank side. Bank service fees and bounced NSF checks are things the bank knows, but the company hasn't recorded yet. So they adjust the book side. The rule is simple. Deposits in transit are added to the bank balance. Outstanding checks are subtracted from it, and service fees and bounce checks are subtracted from the book balance. Each item belongs to exactly one side. In a worked example, the bank starts at $5,000 and the books at $4,900. After adjustments, Both sides land at $4,700. The balances match, confirming the cash records are accurate. When both adjusted balances agree, the company has strong evidence its cash is accounted for. If they don't match, it signals a possible error or fraud worth investigating. Always place each item on the correct side. That's the skill the reconciliation test. Question 11. After a wave of major accounting scandals, a 2002 federal law began requiring senior executives to personally certify the accuracy of their company's financial statements and created a board to oversee the auditors of public companies. Which law is this? Your options are A. The Securities Act of 1933, B. The COSO Integrated Framework, C. The Sarbanes-Oxley Act, D. Generally Accepted Accounting Principles. Before I reveal it, which one do you think is right? The correct answer is C. The Sarbanes-Oxley Act. C is correct because the Sarbanes-Oxley Act of 2002 was passed in response to scandals such as Enron, and its pillars include executive certification of financial statements and the creation of the PCAOB to oversee audit firms. Both features in the scenario are hallmarks of this law. A is wrong because the Securities Act of 1933 created the SEC and required accurate information before investors buy securities, but it predates the 2002 reforms and executive certification. It addressed the initial sale of securities, not personal certification by executives. B is wrong because the COSO Integrated Framework is a voluntary model for designing internal controls, not a federal law that mandates executive certification. It defines control components rather than legal requirements. D is wrong because GAAP is the set of accounting standards companies follow when preparing statements, not a law requiring executive certification or auditor oversight. It governs how figures are reported, not corporate accountability rules. The Sarbanes-Oxley Act, passed in 2008, was Congress's direct response to a wave of accounting scandals, most famously Enron, that devastated investors and shook trust in corporate financial reporting. It imposed sweeping legal requirements on public companies and their auditors. The law rests on 4 pillars. First, companies must test and document internal controls regularly. Second, external auditors must be genuinely independent, thus directly addressing the Arthur Andersen failure. Third, senior executives must personally certify the accuracy of financial statements. Fourth, the Public Company Accounting Oversight Board was created to oversee auditing firms and protect investors. A critical exam point: SOX does not merely require good controls, it requires formal documentation, evaluation, and an auditor report issued after that evaluation. Crucially, the ultimate responsibility for internal controls rests with management, not the auditors. Broadly, SOX increased corporate responsibility, strengthened criminal punishment for financial wrongdoing, expanded accounting regulation, and added new protections over financial reporting, pushing companies toward more careful and honestly certified reporting. When you see a prompt describing required certification and documentation of internal controls with an auditor report following evaluation, that is Sarbanes-Oxley. The year is 2002, the trigger is Enron, and the lasting legacy is the creation of the PCAOB. Question 12. A student is asked which organization is responsible for creating and issuing the accounting standards known as GAAP that companies in the United States follow. Which body is the correct answer? Your options are the SAC, B, the PCAOB, C, the IASB, D, the FASB. What's your answer? Commit to one before I continue. The correct answer is D, the FASB. D is correct because the Financial Accounting Standards Board, or FASB, is the independent non-profit organization that creates and issues US accounting standards which together form GAAP. In short, FASB sets GAAP. A is wrong because the SEC is the federal agency that regulates securities markets and receives public companies' filings, but it does not write the GAAP standards. It enforces market rules rather than authoring accounting principles. B is wrong because the PCAOB oversees the audits of public companies to protect investors, focusing on auditors rather than setting accounting standards. It watches the auditors while FASB writes the rules. C is wrong because the IASB develops IFRS, the international standards used by many other countries, not US. GAAP. It plays the FASB role internationally, not domestically. Accounting doesn't govern itself. Several organizations write the rules, enforce them, and watch the watchmen. In the United States, 3 bodies come up most often, and keeping them straight comes down to one clean sentence each. The Financial Accounting Standards Board writes the accounting rules. The Securities and Exchange Commission is the federal government's regulator of the securities markets. The Public Company Accounting Oversight Board, created by the Sarbanes-Oxley Act, oversees the auditors of public companies to protect investors. The FASB is an independent, non-profit body whose published standards collectively form generally accepted accounting principles, the rule set used across all US, businesses, public and private. It is the standard setter, the organization that writes the financial grammar everyone else must follow. Accounting is not only a domestic affair. Internationally, the dominant rule set is the International Financial Reporting Standards, developed by the International Accounting Standards Board, which plays the same role globally that the FASB plays in the United States. Both exist to make financial statements consistent and comparable across borders. Remember, the FASB writes the rules. The SEC oversees the markets and companies that issue statements, and the PCAOB oversees the auditors who check those statements. One sentence per body, and the trio never blurs together again. Question 13. A small firm wants to ensure that no single employee can handle cash, record the transaction, and approve it alone, so that committing fraud would require more than one person. Which internal control procedure most directly addresses this goal? Your options are A. Physical safeguards, B. Separation of duties, C. Bank reconciliation, D. Adequate insurance. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Separation of duties. B is correct because separation of duties ensures that no single employee controls an entire financial transaction by dividing handling, recording, and approval among different people. Because fraud would then require collusion, it is regarded as the most important control procedure. A is wrong because physical safeguards secure access to cash, inventory, and documents through locks, safes, and restricted areas. They protect assets but do not divide responsibility for a transaction among several people. C is wrong because bank reconciliation compares the company's records with the bank statement to catch discrepancies after the fact. It is a detective control over cash balances, not a way to split duties among employees. D is wrong because adequate insurance protects the company against losses such as theft or disaster, transferring risk rather than preventing one person from controlling a transaction. It does not separate incompatible responsibilities. Internal control rests on a set of on-the-ground procedures, and separation of duties is the most important of them all. The core idea is simple. No single employee should have complete control over a financial transaction. Every transaction is split across 3 independent roles: handling the asset, recording it, and approving it. This means committing fraud would require collusion among multiple people, which is far harder to arrange and far easier to detect. 4 other procedures reinforce separation of duties. Authorization requires management approval before major transactions occur. Reconciliation regularly compares 2 independent sources to catch discrepancies. Physical safeguards secure cash and inventory, and regular audits confirm that financial policies are actually being followed. Separation of duties connects directly to the fraud triangle's opportunity corner. When one person controls an entire transaction, the door to undetected theft is wide open. Splitting those responsibilities closes that opening. A would-be thief now needs a partner, sharply lowering the chance of fraud going undetected. Together, these procedures reduce, but cannot eliminate, the risk of error and fraud. By requiring cooperation to commit wrongdoing, demanding approvals, reconciling records, and auditing regularly, a business closes the openings that fraud would otherwise exploit. Question 14. A company reports total assets of $90,000 and total liabilities of $55,000. Using the accounting equation, what is the company's equity? Your options are A. $35,000, B. $45,000, say 55, and D. 90,000. Which would you go with? Lock it in before the reveal. The correct answer is A. 35,000. A is correct because the accounting equation states that assets equal liabilities plus equity, which rearranges to equity equals assets minus liabilities. Here that is $90,000 minus $55,000, or $35,000. B is wrong because adding assets and liabilities gives $145,000, but equity is the residual left after subtracting what is owed from what is owned, not the sum of the two. Adding them double counts the financing. C is wrong because the figure $55,000 is the liabilities total, which is what the company owes to others, not the owner's residual stake. Equity is assets minus liabilities. D is wrong because the figure $90,000 is total assets, everything the company owns, not the owner's share after debts. Equity remains owner after liabilities are subtracted. The accounting equation is the foundation of all accounting. Assets equal liabilities plus equity. Every financial transaction a business records must keep this relationship perfectly balanced. Assets include cash, inventory, equipment, and buildings. Liabilities include unpaid bills, bank loans, and taxes due. Equity is the residual. It is not a pile of cash, but whatever is left after subtracting what is owed from what is owned. A simple example, a car worth $20,000 with an $8,000 loan outstanding. The bank holds a claim of $8,000. The owner's equity is $12,000, and together they equal the full asset value. The equation balances perfectly. Double entry accounting ensures every transaction affects at least 2 accounts in a way that preserves balance. When the bakery owner invests cash, both cash and equity rise equally. When an oven is bought for cash, one asset rises while another falls. When ingredients are bought on credit, inventory and accounts payable rise by the same amount. The expanded equation breaks equity into its moving parts: capital, revenue, expenses, and draws. Revenue grows equity, expenses and owner draws reduce it. This form quietly contains both the income statement and the statement of owner's equity, making the accounting equation the bridge that connects all the financial statements. Question 15. An accountant needs to record an increase to the company's cash account and an increase to its sales revenue account. Under the dealer rule, how is each increase recorded? Your options are: A. Both are recorded with credits. B. Cash with a credit and revenue with a debit. C. Cash with a debit and revenue with a credit. D. Both are recorded with debits. Don't overthink it. Which one feels right? The correct answer is C. Cash with a debit and revenue with a credit. C is correct because under dealer, assets increase with debits and revenue increases with credits. Cash is an asset, so its increase is a debit, and sales revenue increases with a credit. A is wrong because recording both as credits would wrongly decrease cash because assets increase with debits, not credits. Only the revenue side is a credit. B is wrong because this reverses both accounts. An asset like cash increases with a debit, and revenue increases with a credit, which is the opposite of what this choice states. D is wrong because recording both as debits would wrongly decrease sales revenue because revenue increases with a credit. Only the cash side is a debit. Debits and credits are the engine of double entry bookkeeping, but they only make sense once you strip away their everyday meanings. In accounting, debit simply means the left side of an account, and credit simply means the right side, nothing more. The word dealer organizes all 6 account types. The first 3 letters, draws, expenses, and assets, increase with a debit. The last 3, liabilities, equity, and revenue, increase with a credit. The decrease side follows automatically for every account. Normal balance simply means the side on which an account increases and where its balance ordinarily sits. Assets, expenses, and draws live on the left of the accounting equation and carry a normal debit balance. Liabilities, equity, and revenue live on the right and carry a normal credit balance. A quick example cements the rule. When a bakery sells bread for cash, cash is an asset that increases. Debit it, and sales revenue increases. Credit it. When rent is paid, rent expense increases. Debit it, and cash decreases. Credit it. In every entry, total debits must equal total credits. That equality between debits and credits is the iron law of double entry bookkeeping. As long as you remember dealer, you can figure out the effects of any transaction on any account without memorizing a separate rule for each one. Question 16. A landscaping company completes a $500 job on April 1st, but the customer does not pay until May 16th. Under the accrual basis of accounting, in which month is the $500 of revenue recognized? Your options are A. May, because that is when the cash is received. B. Split evenly between April and May. C. Neither month, because no cash changed hands in April. D. April, because that is when the service was performed. Got a guess? Lock it in. The correct answer is D. April, because that is when the service was performed. D is correct because the revenue recognition principle under accrual accounting records revenue when it is earned, meaning when the service is performed, regardless of when cash arrives. The job was completed on April 1st, so the revenue belongs to April. A is wrong because recording revenue in May when the cash is received describes the cash basis, not the accrual basis. Accrual recognizes revenue when it is earned, not collected. B is wrong because accrual accounting recognizes the full amount of earned revenue in the period the work is completed, not spread across periods. The entire $500 was earned on April 1st. C is wrong because under accrual, revenue is recorded when earned even though no cash moved, because revenue is not the same as cash. The April service created a receivable and the revenue is still recognized. Every accounting system must answer one fundamental question. When exactly should a transaction be recorded? The answer splits all of accounting into 2 distinct approaches, each with different rules and very different results. Under the cash basis, revenue is recorded when cash is received and expenses when cash is paid, like a checkbook. Under the accrual basis, revenue is recorded when earned and expenses when incurred, regardless of when cash actually moves. The revenue recognition principle says revenue is earned when the service is performed or goods are delivered, not when cash arrives. In the mechanic example, the accrual basis records revenue on May 29th, the day the work was done, while cash basis waits until June 2nd. The matching principle requires that expenses be reported in the same period as the revenues they help generate. If December's labor and materials produce December's revenue, those costs belong in December, lining up each period's efforts with its accomplishments. Under accrual accounting, earning and collecting are separate events on different dates. When cash arrives before work is done, it is recorded as unearned revenue, a liability. When work is done before cash arrives, the amount owed is recorded as an account receivable. Revenue is about earning, cash is about collecting. Question 17. At year end, a company must record $300 of insurance that was prepaid earlier and has now been used up. Which statement about this adjusting entry is correct? Your options are: A. It debits insurance expense and credits prepaid insurance and it never touches cash. B. It debits cash and credits insurance expense. C. It debits prepaid insurance and credits cash. D. It requires no entry because the cash already moved earlier. Which one is it? Pause the video if you need more time. The correct answer is A. It debits insurance expense and credits prepaid insurance and it never touches cash. A is correct because the adjusting entry for a used up prepaid expense debits the expense and credits the prepaid asset, moving the consumed portion from asset to expense. Adjusting entries never involve cash because the cash moved earlier in a separate entry. B is wrong because this entry incorrectly involves cash and reverses the expense. While adjusting entries never touch cash, the expense should be debited, not credited. C is wrong because this entry incorrectly involves cash and would increase the prepaid asset rather than reduce it. The used up portion should move out of prepaid insurance, not into it. D is wrong because an adjusting entry is required precisely because the prepaid coverage has now been consumed and must be recognized as expense. Skipping it would overstate assets and understate expenses. Adjusting entries are end-of-period journal entries that bring every account up to date before financial statements are prepared, because accrual accounting records events when they occur rather than when cash moves. These entries capture what falls between the cash dates and period end. Every adjusting entry follows the same structure. It touches one income statement account and one balance sheet account. If you ever see an adjustment that hits cash, that entry is wrong. Cash is handled separately on the date it actually moves. There are 5 adjusting entries to know. Accrued revenue and accrued expense handle amounts earned or incurred, but not yet settled in cash. Prepaid expense and unearned revenue handle cases where cash moved earlier and the earning or using happens later. Depreciation spreads the cost of a long-lived asset across the years it is used. Each of the 5 entries follows the same pattern, one expense or revenue account paired with one balance sheet account. Accrued revenue debits a receivable and credits revenue. Depreciation debits depreciation, expense and credits. Accumulated depreciation a contra asset. In every case, no cash account appears anywhere. The whole purpose of adjusting entries is to close the timing gap between when cash moves and when revenue is earned or an expense is incurred. That is precisely why cash is always left out. It was already recorded the day it changed hands. Question 18. A bakery's main business is selling bread and pastries. During the year, it also sold a small plot of land it owned for $2,000 more than it had paid. How should that $2,000 be classified on the income statement? Your options are: A, as operating revenue because it increased the company's cash. B, as a non-operating gain because it came from outside the core business. C, as an operating expense because the land was a cost. D, as a reduction of cost of goods sold Take a second. Which answer would you pick? The correct answer is B, as a non-operating gain because it came from outside the core business. B is correct because a gain arises from a non-operating activity such as selling an asset for more than it cost, and it is reported separately from revenue. Because selling land is outside the bakery's core business of selling baked goods, the $2,000 is a non-operating gain. A is wrong because revenue comes from the core, repeatable business of selling goods or services, while a one-time land sale is not part of normal operations. Classifying it as operating revenue would overstate the bakery's recurring earnings. C is wrong because the $2,000 is a profit on the sale, not a cost incurred, so it is not an expense. Selling land above its cost increases income rather than reducing it. D is wrong because cost of goods sold reflects the direct cost of products that were sold, not the profit on a land sale. The land transaction has nothing to do with the cost of baked goods. The income statement organizes everything a business earns and spends into 4 distinct categories. Understanding how these categories differ is essential for reading financial statements accurately. 2 items come from core operations: revenue, the money earned selling goods or services, and expenses, the recurring costs of running the business. 2 items come from outside normal operations, gains and losses, which arise from one-time side activities like selling an asset. A bakery illustrates the split clearly. Selling bread is operating revenue. Buying flour and paying rent are operating expenses. But if the bakery sells a plot of land for more than it paid, that $500 difference is a non-operating gain, a one-time windfall, not a repeatable result of the business. Separating these categories tells readers how much profit truly comes from the business itself. Revenue and expenses recur. They reflect what the company does every day. Gains and losses are one-off events that can flatter or hurt profit without saying anything about the health of ongoing operations. When classifying any income statement item, ask one question: does it flow from the core, repeatable business, or from a side activity? Answer that, and the item lands in the right bucket, keeping the income statement an honest picture of how the business truly performs. Question 19. A company reports sales revenue of $200,000, cost of goods sold of $80,000, and total operating expenses of $72,000 with no non-operating items. What is its gross margin and its operating income? Your options are: A, gross margin $128,000 and operating income $120,000. B, gross margin $72,000 and operating income $48,000. C, gross margin $120,000 and operating income $128,000. D, gross margin $120,000 and operating income $48,000. Before I reveal it, which one do you think is right? The correct answer is D. Gross margin $120,000 and operating income $48,000. D is correct because gross margin equals sales minus cost of goods sold, which is $200,000 minus $80,000, or $20,000. Operating income then subtracts operating expenses, $120,000 minus $72,000, giving $48,000. A is wrong because this subtracts the wrong figure for gross margin and miscomputes operating income. Gross margin uses cost of goods sold. $200,000 minus $80,000 equals $120,000, not $128,000. B is wrong because the figure $72,000 is the operating expense total, not gross margin, which is sales minus cost of goods sold of $120,000. This choice mislabels the operating expenses as the gross margin. C is wrong because the two subtotals are swapped. Gross margin is $120,000 and operating income is the smaller $48,000 after operating expenses. So operating income cannot exceed gross margin. The income statement answers the most fundamental question in business. Did the company make a profit? It reports revenues and expenses over a span of time and reduces them to a single bottom line figure using the formula. Revenue minus expenses equals net income. The multi-step format walks through three meaningful subtotals. Sales revenue minus cost of goods sold equals gross margin. Gross margin minus operating expenses equals operating income, the profit from normal recurring business. Finally, operating income adjusted for non-operating items like gains, losses, and interest yields net income. There are two formats for the income statement. The single-step format subtracts all expenses at once. Simple, but it hides gross margin and mixes operating and non-operating items. The multi-step format is more informative and used by roughly 70% of companies. Consider a bakery with $200,000 in sales and $80,000 in cost of goods sold. Gross margin is $120,000. After subtracting $72,000 in operating expenses like wages, rent, and depreciation, operating income is $48,000. Non-operating adjustments then produce the final net income. The income statement is powerful but limited. It records outcomes without explaining causes, covers only a completed period rather than predicting the future, and because it uses accrual accounting and includes non-cash items like depreciation, it does not show whether cash is actually in the bank. That belongs to a different statement entirely. Question 20. A sole proprietor began the year with $50,000 of capital, earned $30,000 of net income, made no additional investments, and withdrew $12,000 for personal use. What is the ending capital balance? Your options are A. $92,000, B. $32,000, C. $68,000, D. $80,000. What's your answer? Commit to one before I continue. The correct answer is C. $68,000. C is correct because the equity roll forward is beginning capital plus net income minus draws. That is $50,000 plus $30,000 minus $12,000, which equals $68,000. A is wrong because the figure $92,000 would result from adding the draws instead of subtracting them, or from including an investment that did not occur. Withdrawals reduce equity, so they must be subtracted. B is wrong because the figure $32,000 subtracts both the net income and the draws from beginning capital, but net income increases equity and should be added. Only the draws are subtracted. D is wrong because the figure $80,000 adds net income to beginning capital but ignores the $12,000 of draws. Owner withdrawals reduce ending capital and cannot be left out. The statement of owner's equity bridges the income statement and the balance sheet. It shows how the owner's stake changed over a period. Starting with beginning equity, tracking every movement, and arriving at ending equity. Equity moves for exactly three reasons. Investments by the owner increase it, net income increases it while a net loss decreases it, and distributions to the owner decrease it. Beginning equity plus or minus all three gives you ending equity. Take a concrete example. A sole proprietor starts the year with $50,000, earns net income of $30,000, and withdraws $12,000. $50,000 plus $30,000 minus $12,000 equals ending capital of $68,000. How equity is labeled depends on legal structure. A sole proprietorship uses owner's capital reduced by withdrawals. A corporation tracks two separate columns, common stock for new share issuances, and retained earnings for accumulated net income minus dividends. One especially common error is treating dividends as an expense. They are not. Dividends are a distribution of already earned profit, so they reduce retained earnings on this statement and never appear on the income statement. Question 21. A corporation's accountant is deciding where to report the dividends the company paid to its shareholders during the year. Which statement about dividends is correct? Your options are: A. Dividends are a distribution of profit that reduces retained earnings and are not an expense. B. Dividends are an operating expense reported on the income statement. C. Dividends increase retained earnings when they are paid. D. Dividends are recorded as revenue on the income statement. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Dividends are a distribution of profit that reduces retained earnings and are not an expense. A is correct because dividends are a distribution of already earned profit to shareholders, so they reduce retained earnings on the statement of stockholders' equity. They are not an expense and never appear on the income statement. B is wrong because dividends are not an expense and do not reduce net income, so they never appear among operating expenses. Treating them as an expense is a classic error. C is wrong because dividends reduce retained earnings rather than increasing it, because they pay profit out of the company. Net income is what increases retained earnings, while dividends decrease it. D is wrong because dividends are paid out to owners, not earned from customers, so they are not revenue. They appear only on the equity statement as a reduction of retained earnings. Corporate equity is built from exactly two pieces: contributed capital and retained earnings. Understanding how each one moves and what moves it is the foundation of corporate accounting. Contributed capital is what owners pay into the business in exchange for shares. Retained earnings are the profits the company has earned over its life but never paid out, sometimes called kept profit. Retained earnings change for exactly two reasons. Net income flows in and raises the balance. Dividends flow out and lower it. Issuing new stock touches only the contributed capital column. Retained earnings are unaffected. Picture retained earnings as a reservoir. Net income pours in from the top. Dividends drain from the bottom. The water level at any moment is every dollar of profit ever kept. The common stock column stands apart. Only new share issuances change it. Dividends are a distribution of profit that has already been earned, so they reduce retained earnings, not net income. They never appear on the income statement. Confusing dividends with an expense is one of the most common errors in corporate accounting, and it is worth guarding against deliberately. Question 22. An analyst notes that one of the four financial statements is unique because it reports a company's position as of a single specific date rather than over a span of time. Which statement is being described and what does it report? Your options are: A. The income statement reporting revenue and expenses over a period. B. The statement of cash flows reporting cash movement over a period. C. The statement of owner's equity reporting changes in equity over a period. D. The balance sheet reporting assets, liabilities, and equity at a point in time. Which would you go with? Lock it in before the reveal. The correct answer is D. The balance sheet reporting assets, liabilities, and equity at a point in time. D is correct because the balance sheet is a snapshot of a company's financial position at one specific date, listing assets, liabilities, and equity, and it proves that assets equal liabilities plus equity. The other three statements each cover a period of time. A is wrong because the income statement reports revenue and expenses over a period of time, not a single date. It answers whether the business earned a profit during that span. B is wrong because the statement of cash flows tracks cash inflows and outflows across a period, not at one instant. It covers a stretch of time like the income statement. C is wrong because the statement of owner's equity reports how equity changed over a period, reconciling beginning to ending equity. It is a period statement, not a point-in-time snapshot. The balance sheet stands apart from the other financial statements because it captures a company's financial position at a single point in time, not across a period. Think of it as a photograph rather than a video. While the income statement, statement of owner's equity, and statement of cash flows each cover a span of time, the balance sheet uses a heading that reads as of a single date. That heading is the instant giveaway. Assets are classified two ways at once. By timing, they are either current or non-current. By physical substance, they are either tangible or intangible. A delivery van is both tangible and non-current. Inventory is both tangible and current. A patent is both intangible and non-current. The balance sheet directly displays the accounting equation. Assets equal liabilities plus equity. Liabilities split into current, due within 1 year like accounts payable, and non-current like mortgages. Equity appears as common stock plus retained earnings, and it is the figure that makes the whole sheet balance. A frequently tested trap. Accounts receivable is an asset because customers owe money to the company. Accounts payable is a liability because the company owes money to suppliers. The word receive or pay inside the name tells you which side of the sheet it belongs on. Question 23. A company owns a delivery van, an office building, a piece of machinery, and a parcel of land. When recording annual depreciation, which of these assets should not be depreciated? Your options are A. The delivery van, B. The land, C. The machinery, D. The office building. Don't overthink it. Which one feels right? The correct answer is B. The land. B is correct because land has an indefinite useful life because it does not wear out, get used up, or become obsolete, so it is never depreciated. Depreciation spreads a cost over a finite useful life, which land does not have. A is wrong because the delivery van wears out over time and has a limited useful life, so it is depreciated like other tangible long-term assets. Vehicles are classic depreciable assets. C is wrong because machinery loses value as it is used and ages, so its cost is spread across its useful life through depreciation. It has a finite life, unlike land. D is wrong because a building deteriorates over time and has a finite useful life, so it is depreciated even though the land beneath it is not. The structure wears out while the land does not. Depreciation is how businesses spread the cost of a long-lived tangible asset across the years it provides benefit, rather than expensing it all at once. This matching principle connects the asset's cost to the periods that actually use it. Equipment, buildings, machinery, and vehicles all depreciate because they wear out or become obsolete. Land, however, is never depreciated. It has an indefinite useful life and does not get used up, making it the one major exception you must remember. The straight line method spreads depreciation evenly each year. You subtract the salvage value from the cost and divide by the useful life. Salvage value is never depreciated away. Only the portion the business expects to consume counts. Take a van bought for $30,000 with a $5,000 salvage value and a 5-year life. Each year, $5,000 of depreciation is recorded. After 5 years, accumulated depreciation totals $25,000 and book value settles exactly at the $5,000 salvage value. Depreciation stops there. The adjusting entry for depreciation debits depreciation expense and credits. Accumulated depreciation E, no cash moves because the asset was already paid for. And if you ever see land listed among depreciable assets, that inclusion is always the error. Question 24. A company pays cash to purchase a new building it will use for years. In which section of the statement of cash flows is this transaction reported? Your options are A. Operating activities because the building is used in daily operations. B. Financing activities, because it involves a large amount of cash. C. Investing activities, because it is the purchase of a long-term asset. D. It is not reported on the statement of cash flows at all. Got a guess? Lock it in. The correct answer is C. Investing activities, because it is the purchase of a long-term asset. C is correct because investing activities include cash spent on or received from buying and selling long-term assets such as equipment, buildings, and land. Purchasing a building is the acquisition of a long-term asset, so it is an investing outflow. A is wrong because although the company will operate using the building, buying a long-term asset is classified as investing, not operating. Operating activities cover day-to-day items like cash from customers and payments to suppliers. B is wrong because financing activities involve owners and lenders, such as issuing stock, borrowing, repaying loans, and paying dividends, not buying assets. The size of the cash outflow does not determine the section. D is wrong because a cash purchase of a building is a real cash outflow and must be reported, specifically in the investing section. Leaving it off would misstate the company's cash activity. The statement of cash flows fills a blind spot that other financial statements leave open. The income statement uses accrual accounting. The balance sheet shows static balances, and neither one tells you whether the business actually has money in the bank. Only the cash flow statement tracks real cash moving in and out over a period. Every cash transaction sorts into exactly one of three sections. Operating covers day-to-day business activity, cash from customers, and payments to suppliers and employees. Investing covers buying or selling long-term assets like equipment and buildings. Financing covers money exchange with owners and lenders, such as issuing stock, borrowing, and repaying loans. The key to classifying any transaction is to ask what the cash was for. Operating cash runs the business. Investing cash acquires or disposes of the big assets used for years. Financing cash reflects how the business is funded by owners and lenders. Each transaction belongs to exactly one bucket determined by its purpose. Consider a bakery. Collecting from customers and paying suppliers are operating flows. Buying a delivery van or selling old equipment are investing flows. An owner's cash contribution and a loan repayment are financing flows. The net of all three sections equals the overall change in cash for the period. Two traps catch students repeatedly. First, buying equipment is always an investing activity, even though you will later use it to operate the business. Second, issuing stock and borrowing or repaying loans are always financing activities because they concern how the business is funded, not how it sells its products. Question 29. A bakery reports a healthy net income for the year, yet its cash balance actually fell during the same period. Which explanation best accounts for this situation? Your options are: much of the revenue was earned on credit and remains uncollected, while cash also went out for equipment and loan repayments. B. Net income and cash are the same figure, so this situation is impossible. C. The income statement must contain an error because profit always equals cash. D. The company forgot to prepare a statement of cash flows. Which one is it? Pause the video if you need more time. The correct answer is A. Much of the revenue was earned on credit and remains uncollected, while cash also went out for equipment and loan repayments. A is correct because net income is accrual-based, recording revenue when earned rather than collected. So profit can be tied up in receivables. Meanwhile, cash can leave for investing outflows like equipment and financing outflows like loan repayments, which do not fully appear as expenses. So a profitable company can still see its cash fall. B is wrong because net income and cash are different measures, because accrual accounting separates earning from collecting. A profitable company routinely has a cash balance that differs from its net income. C is wrong because profit does not always equal cash, so a gap between them does not imply an error. The difference is exactly why a separate statement of cash flows exists. D is wrong because failing to prepare the cash flow statement would not change the actual cash balance, which fell because of timing and outflows. The statement explains the change rather than causing it. The four financial statements aren't separate documents, they form one connected system. The principle linking them is called articulation, meaning the output of one statement becomes the input of the next, forcing them to be prepared in a fixed, logical sequence. The chain runs in a definite order. The income statement calculates net income first. That net income flows into the statement of owner's equity, increasing retained earnings. Ending equity then flows into the balance sheet, proving assets equal liabilities plus equity. Finally, the balance sheet's cash must match the statement of cash flows. Each statement depends on a number the previous one produces. This dependency forces the sequence to run in exactly one direction. You literally cannot prepare them out of order, because each one needs something only the prior statement can supply. Because the statements are wired together, an error in one ripples through all of them. If revenue is overstated by $5,000, that misstatement travels through net income, into equity, and onto the balance sheet, exposing itself automatically. The most important consequence of articulation is understanding why profit and cash differ. Net income is accrual-based. Revenue is recorded when earned, not when collected. Cash can flow out for equipment purchases or loan repayments that aren't full expenses. The statement of cash flows exists precisely to reconcile this gap, reporting how a strong profit and a shrinking bank balance can coexist honestly. Question 26. During a period of rising prices, a company is comparing the FIFO and LIFO inventory methods. Which method produces the higher net income and why? Your options are A. LIFO because it sells the newest, most expensive inventory first. B. FIFO because it sends the oldest, cheapest cost to cost of goods sold. C. Both produce identical net income regardless of price changes. D. LIFO because it leaves the cheapest costs in ending inventory. Take a second. Which answer would you pick? The correct answer is B. FIFO because it sends the oldest, cheapest cost to cost of goods sold. B is correct because FIFO assumes the first and oldest inventory is sold first. So during inflation, the cheapest costs flow to cost of goods sold. A lower cost of goods sold means a higher gross margin and higher net income. A is wrong because LIFO sends the newest and most expensive cost to cost of goods sold during inflation, which raises cost of goods sold and lowers net income. That produces a lower, not higher profit. C is wrong because when prices change, the choice of method changes, which costs flow to cost of goods sold. So net income differs between the two. They are identical only when prices are stable. D is wrong because LIFO does leave older, cheaper costs in ending inventory, but its higher cost of goods sold lowers net income during inflation. The reasoning describes LIFO correctly, but reaches the wrong conclusion about higher income. Cost of goods sold is the direct cost of inventory that actually left the shelf during the period. It is subtracted from sales to produce gross margin, making it one of the most important figures in measuring a business's profitability. The calculation works in two steps. Beginning inventory plus purchases gives you goods available for sale, everything the business could have sold. Subtracting ending inventory from that total leaves cost of goods sold, the portion that actually moved. When prices are rising, the inventory method chosen determines which costs flow to COGS. FIFO sends the oldest, cheapest costs to COGS and keeps newer, pricier costs in ending inventory. LIFO does the opposite, sending the newest, most expensive costs to COGS. The exam critical takeaway is this. under inflation, FIFO produces lower cost of goods sold and higher net income, while LIFO produces higher cost of goods sold and lower net income. The difference comes entirely from which cost layer is assumed to sell first. A common trap is confusing purchases with cost of goods sold. They differ by the change in inventory. Keep the two-step formula clean. And when prices rise, remember FIFO flows cheap costs out first, boosting income, while LIFO flows expensive costs out first, reducing it. Question 27. A shop owner sits down before the year begins and writes out the income she expects to bring in and the expenses she expects to pay over the coming year. What is this document and what fundamental feature defines it? Your options are A balance sheet because it lists what the business owns and owes. B, an income statement because it reports past revenue and expenses. C, a variance report because it compares planned and actual results. D, a budget because it is a forward-looking financial plan of expected income and expenses. Before I reveal it, which one do you think is right? The correct answer is D. A budget because it is a forward-looking financial plan of expected income and expenses. D is correct because a budget is a financial plan that outlines expected income and expenses over a specific period, and its defining feature is that it is forward-looking, made before the period it covers. The owner is planning the year in advance, which is exactly what a budget does. A is wrong because a balance sheet reports assets, liabilities, and equity at a point in time, not expected future income and expenses. It records position rather than a forward plan. B is wrong because an income statement reports revenue and expenses that have already occurred over a past period, while the owner is planning ahead. A budget is the forward-looking counterpart to that backward-looking report. C is wrong because a variance report compares actual results against the budget after the period, so it requires results that have already happened. The owner here is creating the plan, not comparing outcomes to it. A budget is a forward-looking financial plan that estimates both income and expenses over a defined period of time. Understanding what makes a budget unique and why businesses create them is the foundation of managerial accounting. 3 ideas are packed inside the definition. First, a budget is forward-looking. It is written before the period it covers. Second, it has 2 sides estimating both income and expenses. Third, it is always tied to a specific stretch of time. This forward-looking quality is what separates a budget from a financial statement. A budget states what a business intends to happen. A financial statement records what already happened. One plans ahead, the other reports on the past. Businesses budget for 3 reasons: planning, control, and performance evaluation. Planning turns a vague hope of profit into a concrete numerical target. Control lets the owner steer midstream and catch overspending while there is still time to act. Performance evaluation compares actual results against the plan after the period ends, turning every gap into a lesson for the next budget. Together, these 3 purposes form a continuous cycle. A business plans ahead, steers itself during the period, and then judges its results. And those judgments feed directly into a sharper plan for the next period. Without a budget, a business simply reacts. With one, it measures itself against its own intentions. Question 28. A bakery owner is preparing a budget focused on the timing of cash coming in from customers and cash going out for the supplier, payroll, and rent, to make sure enough cash is on hand when each bill is due. Which budget is she preparing? Your options are A, the sales budget, B, the production budget, C, the financial budget, D, the operating budget. What's your answer? Commit to one before I continue. The correct answer is C, the financial budget. C is correct because the financial budget depicts expected cash inflows and outflows and the resulting financial position, focusing on whether cash will be available when needed. Tracking the timing of cash in and out to cover bills is the work of the financial budget, whose best known component is the cash budget. A is wrong because the sales budget forecasts future sales in units and dollars, not the timing of cash payments and receipts. It estimates demand rather than managing cash flow. B is wrong because the production budget plans how much to manufacture to meet expected sales, driving materials and labor needs. It addresses output levels, not cash timing. D is wrong because the operating budget covers day-to-day operations such as sales, production, and overhead, while the cash timing focus described belongs to the financial budget. Operating means running the business, financial means funding it. Every business runs not on one budget, but a whole family of them. At the top sit two master categories, the operating budget and the financial budget. Everything else nests beneath these two. The operating budget is about running the business, covering production, sales, overhead, and operating costs. The financial budget is about financing the business, tracking cash inflows, cash outflows, and the resulting financial position. The operating budget asks, what will we make and sell and what will that cost? The financial budget asks, when will cash actually arrive and leave? And will we have enough on hand when each bill comes due? The quickest way to classify any budget is to ask what it is about. If it concerns making, selling, or overhead, it belongs to the operating budget. If it concerns the timing of cash coming in and going out, it belongs to the financial budget. These two budgets are partners, not rivals. A sound operating plan can still fail if the cash to support it arrives at the wrong time. The financial budget exists to anticipate exactly that gap before it becomes a crisis. Question 28. When a company prepares its family of budgets, one budget is almost always built first because nearly every other budget depends on it. Which budget is built first and why? Your options are A. The sales budget, because expected sales determine how much to produce and spend. B. The cash budget, because liquidity must be planned before anything else. C. The production budget, because output drives the sales forecast. D. The financial budget, because cash position comes before operations. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. The sales budget, because expected sales determine how much to produce and spend. A is correct because the sales budget is the starting point because how much a company expects to sell determines how much it must produce, which in turn determines the materials, labor, and other costs to plan. Sales is the domino that knocks over all the other budgets. B is wrong because the cash budget depends on the inflows and outflows that follow from planned sales and production, so it cannot come first. Liquidity planning relies on figures the sales budget generates. C is wrong because production follows from the sales forecast, not the other way around, because a company makes what it expects to sell. The sales budget drives production, so production cannot precede it. D is wrong because the financial budget, including cash position, is built from the activity the operating budgets plan, which begins with sales. Sales must be forecast before cash flows can be estimated. Every business budget belongs to a connected family, and that family has a definite order. Understanding why that order is forced and how each budget feeds the next is the real insight here. The chain always begins with the sales budget, a forecast of expected units sold and the dollars they represent. Sales drives production, and production drives the cost and cash budgets that follow. You cannot sensibly plan what to make or spend until you know what you expect to sell. The production budget is the critical translator. It converts the sales forecast into a manufacturing target, which then sets the required materials and labor, Below those sit the operations budget covering overhead like rent and utilities. And finally, the cash budget, which plans the timing of every dollar the whole chain will move. Each budget in the chain depends on the one above it. A higher sales forecast immediately raises the production target, which raises planned ingredient and wage costs, which changes the cash picture. The whole structure flexes together because no lower budget can be set before the one feeding it is decided. Think of the sales budget as the first domino. Once it falls, every other budget must adjust in sequence. That chain of dependence is not a convention. It is the logical structure of how business activity actually works. Question 30. A profitable bakery worries that on the 10th of the month a large flour bill is due, but the catering client who owes it money will not pay until the 25th. Which budget is designed to address this worry, and what concept is at stake? Your options are A. The sales budget addressing demand, B. The cash budget addressing liquidity, C. The production budget addressing output, D. The operating budget addressing overhead. Which would you go with? Lock it in before the reveal. The correct answer is B. The cash budget addressing liquidity. B is correct because the cash budget forecasts cash inflows and outflows to manage liquidity, which is having actual cash on hand when bills come due. The timing mismatch between the flour bill and the customer payment is exactly the liquidity problem the cash budget exists to catch. A is wrong because the sales budget forecasts how much the bakery expects to sell, not whether cash will be available on a given day. It addresses demand, not the timing of payments. C is wrong because the production budget plans how much to bake to meet sales, addressing output levels rather than cash timing. It does not track when money arrives or leaves. D is wrong because the operating budget covers the day-to-day costs of running the bakery, such as overhead, but the specific cash timing worry belongs to the cash budget. Profit on paper does not guarantee cash in the drawer, which is a liquidity matter. The cash budget is a business's day-to-day tool for managing liquidity, ensuring actual cash is available at the exact moment it's needed. It lives inside the broader financial budget and forecasts when cash flows in and out. Profit and cash are not the same thing. Profit is measured on an accrual basis, revenue counted when earned, expenses when incurred. Cash is what's physically in the account. A bakery can record a profitable month yet still be short on a specific day if a client hasn't paid yet, or a large bill arrived early. A concrete example makes this clear. Rent is due on the 1st, a flour order on the 10th, and payroll on the 15th, but the catering client who owes $6,000 doesn't pay until the 25th. The cash budget lets the owner see that gap weeks in advance. The real power of the cash budget is timing. Spotting a shortfall early lets the owner act, ways same, delaying a discretionary purchase, accelerating a collection, or lining up a short-term line of credit. Without it, the shortfall arrives as a surprise with little time to respond. The sales, production, and operating budgets each serve a purpose, but only the cash budget answers whether the money will physically be there when each payment comes due. Liquidity is the issue it resolves, and anticipating the squeeze is always better than scrambling once it hits. Question 31. A 20-year-old manufacturer with steady, predictable revenue builds next year's budget by taking last year's figures and adjusting each line slightly for inflation and modest growth. Which budgeting method is this, and what does it assume? Your options are A. Zero-based budgeting, which assumes every cost must be justified from scratch. B. Variance analysis, which assumes actual results are already known. C. Flexible budgeting, which assumes activity levels will change. D. Incremental budgeting, which assumes financial stability and that past patterns continue. Don't overthink it. Which one feels right? The correct answer is D, incremental budgeting, which assumes financial stability and that past patterns continue. D is correct because incremental budgeting builds the new budget from the prior budget by making minor adjustments, and it assumes financial stability, meaning past spending patterns will continue. A mature firm with steady revenue is the textbook fit, because building on previous budgets yields reliable projections. A is wrong because zero-based budgeting starts every line from zero and requires each cost to be justified fresh, which is the opposite of adjusting last year's numbers. The scenario describes building on the prior budget, not a clean slate. B is wrong because variance analysis compares actual results to the budget after the period, rather than being a method for building the budget. The scenario is about creating next year's plan, not evaluating outcomes. C is wrong because flexible budgeting prepares figures for multiple activity levels and flexes to actual volume, which is a different idea from nudging last year's single budget. The method shown adjusts a prior budget rather than building several activity level versions. Incremental budgeting builds each new budget on top of the previous one, making only small adjustments rather than starting from scratch. It is often called the traditional approach precisely because of its simplicity and consistency. Think of it as a baker who keeps last year's recipe and adjusts a few amounts, a little more flour for bigger batches, a little less of something that got expensive. The structure stays intact, only the quantities shift. The method works in 3 basic moves. It starts with last year's budget as the foundation, makes small adjustments for factors like inflation or expected growth, and carries forward most of the existing structure without major change. Its strengths are real. It is simple, efficient, and meets low resistance because no one's entire budget is suddenly on the chopping block. But its weaknesses are equally real. It carries past inefficiencies forward and adapts slowly to sharp changes. Incremental budgeting assumes financial stability that next year will look much like this year. That assumption makes it a strong fit for stable organizations like government agencies and established institutions, but a poor choice for rapidly growing startups whose finances change too fast for last year's budget to be a useful starting point. Question 32. A company has used incremental budgeting for 15 years, bumping each line up a few percent annually out of habit without re-examining it. Over time, several line items have quietly doubled even though the activity they support barely grew. What is this phenomenon called? Your options are A. Budget creep, B. Goal congruence, C. Zero-based budgeting, D. A favorable variance. Got a guess? Lock it in. The correct answer is A. Budget creep. A is correct because budget creep, also called budgetary slippage, is the accumulation of small increases over time into bloated budgets that grow without an equivalent increase in revenue or value. The habit of nudging each line up annually without scrutiny is exactly how creep compounds. B is wrong because goal congruence is the alignment of a manager's goals with the company's goals, a responsibility accounting idea unrelated to budget bloat. It does not describe spending that grows unchecked. C is wrong because zero-based budgeting is the cure for creep, not the phenomenon itself, because it forces every dollar to be rejustified. The scenario describes the problem that zero-based budgeting is designed to fix. D is wrong because a favorable variance is a result better than budgeted, such as lower costs, not the gradual swelling of a budget over years. The scenario describes rising allocations, not a positive comparison to plan. Budget creep, also called budgetary slippage, is the gradual swelling of a budget through small, compounding increases over time. The key feature is that spending grows without a matching rise in revenue or value, making it a silent drain on resources. The danger of budget creep is that each individual increase looks reasonable in isolation. 3% here, 5% there. Nothing alarming. But those nudges stack on top of one another until the budget has quietly doubled. A bakery's office supplies line starts at $1,000. Bumped 5% each year out of habit, it quietly climbs past $2,000 after 15 years. Not because the need grew, but because last year's figure was treated as a flaw. Budget creep is the signature flaw of incremental budgeting, because that method never forces anyone to ask whether a cost is still justified. Zero-based budgeting is the direct cure. It rebuilds every line from scratch, stripping out the waste that compounding had quietly buried. Recognizing budget creep means understanding it is not a variance result or a goal alignment issue. It is accumulated waste built year by year. The only real remedy is the disciplined from-scratch review that incremental budgeting never demands. Question 33. Under one budgeting method, every department starts each period at zero and must justify each expense from scratch based on current needs and goals, regardless of what it received last year. Which method is this, and what is the primary basis for allocating funds? Your options are A. Incremental budgeting, allocating based on the previous year's amounts. B. Trend analysis, allocating based on historical patterns. C. Zero-based budgeting, allocating based on how well each department justifies its needs. D. Static budgeting, allocating based on a single fixed activity level. Which one is it? Pause the video if you need more time. The correct answer is C. Zero-based budgeting, allocating based on how well each department justifies its needs. C is correct because zero-based budgeting is a clean slate method in which divisions justify their needs from zero, and funding is awarded based on how well each department justifies its needs rather than on history. The strongest justification wins the dollars. A is wrong because incremental budgeting allocates based on the previous year's budget, adjusted slightly, which is exactly the history-based approach that zero-based budgeting rejects. Starting from zero rules out incremental budgeting. B is wrong because trend analysis studies historical data to predict future performance, not a method for allocating departmental budgets from zero. It identifies patterns rather than justifying expenses. D is wrong because static budgeting refers to building a budget for a single fixed activity level, not to justifying every expense from a base of zero. It describes how volume is handled, not the justification process. Zero-based budgeting throws out the prior year entirely and demands that every dollar be justified from scratch. Unlike incremental budgeting, which tweaks last year's numbers, this method starts at zero and builds up only what can be proven necessary. The process runs in 3 steps. First, each department starts with a blank slate and justifies every expense from zero. Second, each proposed cost is evaluated against real business needs and strategic goals. Third, justified costs are ranked by importance, and anything that doesn't make the cut is eliminated. Money flows to the highest impact needs first. Each budget period is a fresh cycle. Departments justify their needs. Costs are evaluated and ranked, and only the strongest justifications receive funding. Then the cycle resets. Last year's approval earns nothing this year. The method's strengths are real. It drives cost efficiency, eliminates wasteful spending, and encourages fresh thinking. But the drawbacks are equally real. It is time-consuming, potentially disruptive, and can cause businesses to undervalue long-term investments like training or research that only pay off over time. Zero-based budgeting suits companies where last year is a poor guide to next year. Think retail, airlines, and technology. It buys cost discipline at the price of significant effort, and whether that trade is worthwhile depends entirely on the nature of the business. Question 34. A rapidly growing technology startup doubles its headcount and revenue every year. So last year's budget is a poor guide to next year's needs. Which budgeting method best fits this company and why? Your options are A. Incremental budgeting, because it is simple and builds on last year. B. Zero-based budgeting, because the company's instability makes justifying from scratch more reliable. C. Incremental budgeting, because startups have stable, predictable costs. D. Static budgeting, because a single activity level never changes. Take a second. Which answer would you pick? The correct answer is B. Zero-based budgeting, because the company's instability makes justifying from scratch more reliable. B is correct because incremental budgeting assumes financial stability, which a fast-growing startup lacks. So building on last year's tiny budget would badly understate real needs. Zero-based budgeting fits the fast-changing reality by justifying each expense from scratch rather than relying on an outdated base. A is wrong because although incremental budgeting is simple, its foundation is the assumption that past patterns continue, which is false for a doubling startup. Simplicity does not help when last year is a useless guide. C is wrong because a rapidly growing startup does not have stable, predictable costs, so the premise of this choice is wrong. Its finances change dramatically year to year. D is wrong because static budgeting describes preparing a budget at one fixed activity level, which is unrelated to choosing between incremental and zero-based approaches. It also poorly suits a company whose activity is changing rapidly. When choosing a budgeting method, the decision comes down to a few key factors. Understanding the underlying logic of each method makes any scenario question straightforward to resolve. The two methods are near mirror images of each other. Incremental budgeting is fast, simple, and stable but risks budget creep, while zero-based budgeting eliminates waste and drives innovation at the cost of time and disruption. 3 factors determine which method fits. First, financial stability. Stable organizations lean incremental, volatile ones lean zero-based. Second, cost control priority. If waste is urgent, zero-based is the remedy. Third, strategic appetite. Innovation favors zero-based, while steady operations favor incremental. A rapidly growing startup is a classic exam trap. Because incremental budgeting assumes financial stability, a startup's unstable. Shifting costs make last year a useless base, pointing firmly towards zero-based budgeting instead. Finally, the choice is not strictly either or. Many businesses run incremental budgeting for stable departments and apply zero-based budgeting where costs are ballooning or strategy is shifting. And that blend is often the smartest answer of all. Question 35. A monthly report flags a $2,000 unfavorable variance in a bakery's ingredient costs. A manager assumes this automatically proves that someone wasted ingredients. Why is that assumption flawed? Your options are: A. Variance analysis always identifies the exact cause of a problem. B. An unfavorable variance is always the fault of an employee. C. A variance proves fraud has occurred and the transaction should be reversed. D. Variance analysis only indicates where a problem may exist, not what caused it. Before I reveal it, which one do you think is right? The correct answer is D. Variance analysis only indicates where a problem may exist, not what caused it. D is correct because a variance is a signpost, not a diagnosis, so it indicates where to investigate rather than what went wrong. The $2,000 gap could come from a supplier price increase, ordinary waste, or a deliberate quality decision, and only further analysis reveals the cause. A is wrong because variance analysis does not identify the exact cause. It flags the location of a possible problem for humans to investigate. Finding the actual cause is a separate step. B is wrong because an unfavorable variance is not automatically anyone's fault. since valid reasons include higher supplier costs or lower sales outside the manager's control. Labeling a default skips the analysis of cause. C is wrong because A variance does not prove fraud and does not trigger any automatic reversal of transactions. It simply points to an area worth examining. Variance analysis is one of the most tested topics in budgeting. It is a disciplined process for comparing what a business planned to spend or earn against what actually happened, and using those findings to build smarter plans going forward. A variance is simply that numeric gap. If you budgeted $7,500 for ingredients but spent $8,000, the variance is $500. Every line of a budget can produce its own variance, favorable or unfavorable. The process follows 3 steps in order. First, calculate the difference. This is the arithmetic step. Second, analyze the cause, but only when the gap is significant enough to be worth investigating. Third, adjust future budgets based on what was learned, closing the loop so the next period's plan is better. Here is the critical insight. A variance is a signpost, not a diagnosis. When analysis flags a $2,000 unfavorable ingredient variance, it does not reveal what went wrong. The cause could be a supplier raising prices, kitchen waste, or a deliberate upgrade. The variance only points to where people should look next. This distinction is what makes variance analysis practical, because managers focus only on large or unusual gaps, the exceptions that matter. They can review thousands of transactions efficiently. The tool narrows the search. Determining what actually happened and deciding what to do remains a human task. Question 36. A bakery budgeted $12,000 for ingredients but actually spent $12,800. How large is the variance and is it favorable or unfavorable? Your options are A. An $800 unfavorable variance because the actual expense exceeded the budget. B. An $800 favorable variance because the actual expense exceeded the budget. C. A $20,800 unfavorable variance because the two figures are added. D. An $800 favorable variance because spending more is good for the business. What's your answer? Commit to one before I continue. The correct answer is A. An $800 unfavorable variance because the actual expense exceeded the budget. A is correct because the variance is the difference between actual and budget, which is $12,800 minus $12,000 or $800. For an expense, spending more than budgeted hurts profit, so the variance is unfavorable. B is wrong because the $800 amount is correct, but spending more on an expense than planned is unfavorable. Not favorable, because it reduces profit. Favorable would require the actual expense to come in below budget. C is wrong because variances are found by subtracting the budget from the actual, not by adding the two figures. Adding them produces a meaningless total rather than the $800 difference. D is wrong because spending more than budgeted on an expense reduces profit. So it is unfavorable, not favorable. Overspending is not good for the business in this comparison. When a budget figure differs from actual results, we label that difference a variance. The key question is never simply whether the actual number came in above or below budget. It is whether the difference helped or hurt profit. More revenue helps profit and is favorable. Less revenue hurts profit and is unfavorable. Lower expenses help profit and are favorable. Higher expenses hurt profit and are unfavorable. Profit is the compass that points to the right label every time. Consider a bakery that budgeted $12,000 for ingredients but spent $12,800. The variance is $800. Because an expense came in above budget, profit is reduced and the variance is unfavorable. The direction matters as much as the size. Favorable and unfavorable are accounting labels, not moral judgments. A business that overspent on labor to meet booming demand has an unfavorable variance, yet the decision may have been exactly right. Always look behind the label to understand why the variance occurred. A full variance report can show unfavorable expenses yet still beat the profit target if revenue is strong enough. Read every line and the bottom line together. Each variance is a signpost, and net income reports the overall score. Question 37. A company sold fewer units than its single volume budget assumed, and its cost lines all came in lower than that budget, making cost control look excellent even though profit fell. Why does a flexible budget give a fairer performance comparison than the static budget? Your options are A. A flexible budget always shows higher profit than a static budget. B. A flexible budget ignores fixed costs entirely. C. A flexible budget recalculates the plan at the actual volume, separating the volume effect from true cost control. D. A flexible budget uses last year's figures instead of this year's. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. A flexible budget recalculates the plan at the actual volume, separating the volume effect from true cost control. C is correct because a flexible budget first rebuilds the plan at the actual volume achieved, with variable costs flexing and fixed costs staying put, then compares. This separates the effect of selling a different number of units from the effect of managing costs well, removing the volume distortion that made the static comparison look misleadingly favorable. A is wrong because a flexible budget does not automatically show higher profit. It simply provides a fairer benchmark at the actual volume. The resulting variances can be favorable or unfavorable. B is wrong because a flexible budget includes fixed costs, holding them constant while flexing the variable costs. It does not ignore fixed costs. D is wrong because a flexible budget uses the current period's per unit rates applied to the actual volume, not last year's figures. The flexing is about activity level, not a prior year. Most businesses start with a static budget, a single plan built for one expected volume that never changes. A flexible budget, by contrast, recalculates the plan to match whatever volume actually occurred. The key question is, why does that distinction matter so much for measuring performance? When actual volume is lower than planned, variable costs naturally fall too, not because anyone managed them well, but simply because the business did less. Comparing those lower actual costs against a static budget built for higher volume is comparing apples to oranges, and it creates a flattering but false picture. The mechanics are precise. Variable costs flex because they are per unit and scale with volume. Fixed costs stay put because they do not move with volume within the relevant range. Flexing rebuilds the plan at actual units, so any remaining variance reflects genuine efficiency or inefficiency. SAR sued, not just a volume difference. A static budget blends the volume effect and the cost control effect into a single variance, making it impossible to tell them apart. A flexible budget pulls them apart. Only by rebuilding the plan at the actual volume can you see whether costs were truly well managed or whether the numbers just looked good because the business did less. The flexible budget gives an honest performance measure. It removes the distortion of volume differences so managers can see what really drove results. True cost control, not just the artifact of a slower period. Question 38. An exception report flags a $40,000 payment made at 3 a.m. on a Sunday for further review. What has the report actually accomplished? Your options are A. It has proven that fraud occurred and identified the culprit. B. It has flagged an unusual transaction for a human to investigate. C. It has automatically cancelled the suspicious transaction. D. It has guaranteed that no fraud can ever occur again. Which would you go with? Lock it in before the reveal. The correct answer is B. It has flagged an unusual transaction for a human to investigate. B is correct because exception reporting flags transactions that fall outside normal ranges, such as unusually large or oddly timed payments, so a person can review them. It highlights items for further review rather than concluding anything on its own. A is wrong because a flagged transaction is suspicious, not proven fraudulent, and the report does not identify a culprit. There may be an innocent explanation that only investigation can reveal. C is wrong because exception reporting does not cancel or reverse transactions, it only raises a flag for review. The decision to act stays with people. D is wrong because exception reporting cannot guarantee that fraud will never occur, because it catches signs after the fact rather than preventing all wrongdoing. It is an early warning tool, not a guarantee. When budgets accumulate over many periods, two powerful tools help managers make sense of that history. Trend analysis looks across periods for patterns, while exception reporting looks within the data for outliers. Together they turn raw variance history into actionable insight. Trend analysis lines up budget versus actual results across multiple periods, so patterns become visible. A consistent 5% revenue rise every quarter signals steady growth, not seasonality, not randomness. Naming the pattern correctly is what allows trend analysis to feed a reliable incremental budget forecast. It matters which pattern you are seeing. Steady growth is a consistent directional change each period. Seasonality is a repeating calendar cycle. A beach shop's huge summers and quiet winters. Unpredictability is neither, and only a steady trend supports a confident incremental forecast. Exception reporting solves a practical problem. Managers cannot scrutinize thousands of transactions. It filters routine items and flags only the outliers, unusually large payments, repeated voids, or activity at odd hours. Critically, flagging is all it does. It raises a warning for a human to investigate. It does not prove fraud, prevent fraud, or automatically reverse any transaction. The correct exam verb is always flags or highlights for review. Any answer claim in exception reporting proves fraud, eliminates fraud, or cancels a transaction, overstates its power and is wrong. It is an early warning flag, not a judge, not an executioner. Question 39. In one organization, strategic direction flows from the top down, a clear chain of command. With lower levels executing orders rather than setting overall strategy, much like the military. How is this organization best described? Your options are A. Centralized, B. Decentralized, C. A discretionary cost center, D. A flexible budget. Don't overthink it. Which one feels right? The correct answer is A. Centralized. A is correct because a centralized organization concentrates the important decisions and strategic direction in one authority at the top, and the military is the classic example. Lower levels carry out orders rather than setting strategy. B is wrong because a decentralized organization spreads decision-making across many levels, as in a university where professors, chairs, and deans each decide. That is the opposite of the top-down structure described. C is wrong because a discretionary cost center is a responsibility accounting unit such as marketing or human resources, not a description of how decision authority is distributed. It addresses what a manager is judged on, not centralization. D is wrong because a flexible budget is a budgeting tool that adjusts to activity levels, unrelated to organizational structure. It does not describe where decisions are made. When a business decides who makes which decisions, it's choosing its organizational structure. That choice is the foundation for holding anyone accountable. You can't measure someone on results they don't control. There are two ends of the spectrum. A centralized organization like the military concentrates decisions at the top and flows direction downward. A decentralized organization, like a university, spreads decision-making across multiple levels. Professors, department chairs, deans, and a provost each deciding within their own domain. Neither structure is automatically better. Centralization gives consistent direction and tight control, but the top can become a bottleneck. Decentralization uses frontline knowledge and develops managers, but units can drift in different directions. And that misalignment problem is exactly what responsibility accounting is designed to solve. As companies grow, they divide into segments, uniquely identifiable components like a division, product line, geographic region, or department. For a bakery, that might mean a retail storefront, a wholesale operation, and a catering business. Each segment has a clear boundary so it can be measured on its own. The whole arc runs from structure to accountability. A business picks how centralized or decentralized to be, carves itself into identifiable segments, and assigns a responsible manager to each one. Matching managers to the right segments and the right performance measures is exactly what responsibility centers address next. Question 40. A manager of a single retail store location controls both the store's sales and its costs, and is evaluated on the store's profitability. Which type of responsibility center does this manager lead? Your options are A. A cost center, B. A revenue center, C. An investment center, D. A profit center. Got a guess? Lock it in. The correct answer is D. A profit center. D is correct because a profit center is a segment whose manager is responsible for both revenues and costs, with performance measured by profitability. A retail store manager who controls sales and costs and is judged on profit fits this definition exactly. A is wrong because a cost center's manager controls only costs and has no control over revenue, so it does not fit a manager who also drives sales. The store manager is responsible for both sides. B is wrong because a revenue center's manager is accountable only for revenues, not for managing cost, which is narrower than the profit responsibility described. This manager controls costs too. C is wrong because an investment center's manager is accountable for profits and the invested capital, making major investment decisions beyond running the store. The scenario does not mention control over capital investment, so profit center is the better fit. Responsibility accounting holds each manager accountable for only what they actually control. The key is knowing which of the 5 responsibility centers a segment belongs to. And that comes down to one question. What does this manager get to control? The 5 centers form a ladder of increasing responsibility. At the bottom, cost centers and discretionary cost centers manage spending. Revenue centers focus purely on sales. Profit centers own both sides of the income equation. And investment centers sit at the top, also governing the capital the segment deploys. Picture a ladder. Each rung adds one more dimension of control. A production department sits near the bottom as a cost center. A retail store manager climbs to profit center because they influence both sales and spending. A regional headquarters reaches the top as an investment center, responsible for whether the capital it commands is being used wisely. To classify any segment, work down from the top. First, ask whether the manager makes major capital investment decisions. If yes, it is an investment center. If not, check whether they control both revenue and costs for a profit center, revenue only for a revenue center, or costs only for a cost center. The whole system rests on one fairness principle: never hold a manager accountable for results outside their control. Match the center to the manager's actual authority, and performance measurement becomes meaningful. Question 41. A company's marketing department spends money to build the brand, but no one can precisely tie those dollars to a specific amount of extra sales. Which type of responsibility center is the marketing department? Your options are A revenue center, B, a discretionary cost center, C, a profit center. D, an investment center. Which one is it? Pause the video if you need more time. The correct answer is B, a discretionary cost center. B is correct because a discretionary cost center manages controllable costs but has only an indirect, hard-to-measure link to revenue, which is the defining trait of departments like marketing, human resources, and accounting. Because the spending to results relationship is not well defined, the manager is judged on spending the budget wisely. A is wrong because a revenue center is accountable only for generating sales, such as an airline reservations group, not for managing a budget with a fuzzy link to revenue. Marketing does not directly book the sales it influences. C is wrong because a profit center controls both revenues and costs and is judged on profit, but marketing does not control a clear revenue stream. The loose tie between its spending and sales rules out a profit center. D is wrong because an investment center is responsible for profits and invested capital, which is far broader than a department managing a discretionary budget. Marketing does not make major capital investment decisions here. A discretionary cost center is one of the trickiest responsibility centers to understand. Its defining feature is that the manager controls costs, but those costs have only an indirect, hard-to-measure link to revenue. Unlike a production line where labor hours translate directly into units, a discretionary cost center cannot draw that clean line. The manager is accountable for spending the budget wisely, not for hitting a precise output number. Marketing, human resources, accounting, and training are the standard examples. Each department spends real money, serves a genuine purpose, yet no one can isolate exactly how many dollars of their spending translate into additional revenue. This contrast is the heart of the concept. In a plain cost center, the input to output relationship is direct and measurable. In a discretionary cost center, that relationship is real but fuzzy, which is precisely why it forms its own category. A discretionary cost center is not a revenue center, which is judged on direct sales. It is not a profit center, which controls both a clear revenue stream and costs. And it is not an investment center, which carries responsibility for major capital decisions. Controlling only a budget with an indirect revenue link is what sets it apart. Question 42. A delivery manager can plan the routes the trucks take, but cannot influence the price per gallon of fuel set by the oil market. When evaluating this manager's performance, why should the fuel price not be held against them? Your options are: A. Fuel price is a product cost and therefore irrelevant to performance. B. Fuel price is always lower than budgeted, so it never matters. C. Fuel price is an uncontrollable cost the manager cannot significantly influence. D. Fuel price is a fixed cost and fixed costs are never evaluated. Take a second. Which answer would you pick? The correct answer is C. Fuel price is an uncontrollable cost the manager cannot significantly influence. C is correct because an uncontrollable cost is one a specific manager cannot significantly influence within the relevant time frame, and the market price of fuel is a stated example. Fairness in responsibility accounting means judging a manager only on costs they can actually influence, such as the miles driven, not the price per gallon. A is wrong because whether fuel is a product or period cost does not determine fairness of evaluation. The issue is controllability. The reason to exclude it is that the manager cannot influence the market price. B is wrong because fuel prices are not always lower than budgeted and can spike unexpectedly, which is precisely why they are uncontrollable. The claim that the price never matters is incorrect. D is wrong because fuel cost per gallon used by trucks behaves as a variable cost tied to usage, not a fixed cost. And fixed costs are in fact evaluated where controllable. The real reason is controllability, not a blanket rule about fixed costs. In decentralized organizations, every manager pursues their own unit's targets, but those targets must be designed so that helping the unit also helps the company. Two principles make that work: goal congruence and the controllability rule. Goal congruence means what is good for the manager and what is good for the company are the same thing. A store manager rewarded only for cutting costs might slash staffing until service collapses. The bonus improves, but the business suffers. Rewarding the manager on store profit instead ties their incentive directly to overall success. The controllability principle says a manager should only be judged on costs they can actually influence. Miles driven and staff scheduling are controllable. The manager decides them. Fuel price and electricity rates are uncontrollable. The market sets them, not the manager. Choosing whether a manager owns costs, revenues, profits, or invested capital is ultimately an effort to engineer goal congruence. The right responsibility center ensures the number the manager is judged on genuinely reflects company success, so their decisions naturally benefit the whole organization. Controllability also shifts with role and time frame. Rent is uncontrollable for a shift supervisor this month, but fully controllable for a director negotiating next year's leases. Holding managers accountable only for what they can influence is what makes responsibility accounting both fair and motivating. Question 43. A bakery incurs the following costs: flour used in bread, baker's wages, electricity that runs the production ovens, and a newspaper advertisement. Which of these is a period cost that is expensed immediately rather than a product cost? Your options are A. The newspaper advertisement, B. The flour used in bread, C. The baker's wages, D. The electricity that runs the production ovens. Before I reveal it, which one do you think is right? The correct answer is A. The newspaper advertisement. A is correct because period costs are non-manufacturing selling and administrative costs that are expensed in the period they occur, and advertising is a selling cost. The other three are the components of product cost and weight in inventory until the goods sell. B is wrong because flour used in bread is direct materials, a product cost that becomes inventory and then cost of goods sold when the bread is sold. It is not expensed immediately. C is wrong because the baker's wages are direct labor, a product cost attached to the goods produced. The cost flows through inventory rather than being expensed at once. D is wrong because electricity that runs the production ovens is manufacturing overhead, a product cost required to make the goods. It is inventoried, not expensed immediately like advertising. Every cost a business incurs must be classified as either a product cost or a period cost. This single distinction controls when a cost appears on the income statement and how inventory is valued on the balance sheet. A product cost has three components: direct materials, direct labor, and manufacturing overhead. These costs attach to the product and sit on the balance sheet as inventory until the product is sold, at which point they move to the income statement as cost of goods sold. This is what makes product costs unique. They are inventoriable. The cost waits as an asset until the sale triggers its release as an expense. Period costs have no such delay. They are expensed immediately in the period they occur, never passing through inventory at all. Two traps catch students: rent and salaries. Factory rent is manufacturing overhead, a product cost, while office rent is a period cost. A baker's wage is direct labor, a product cost, while the CEO's salary is a period cost. The key question is always whether the cost is tied to making the product. Getting this classification right anchors managerial accounting. Inventory value includes only product costs. Gross profit depends on cost of goods sold built from product costs. And period costs like advertising never touch the value of unsold goods. Question 44. A furniture maker incurs direct materials, direct labor, and manufacturing overhead to build a table that has not yet sold. Where do these product costs appear in the financial statements before the table is sold? Your options are A. As an expense on the income statement immediately. B. As a liability on the balance sheet. C. As revenue on the income statement. D. As inventory and asset on the balance sheet. What's your answer? Commit to one before I continue. The correct answer is D. As inventory and asset on the balance sheet. D is correct because product costs are attached to the goods and recorded as inventory, an asset on the balance sheet, until the product sells. Only when the table is sold does that cost move to the income statement as cost of goods sold. A is wrong because a product cost is not expensed when incurred. It becomes an expense only when the product sells. Until then, it sits in inventory rather than on the income statement. B is wrong because inventory is an asset representing something the company owns, not a liability it owes. Product costs increase assets, not obligations. C is wrong because the costs of making the table are not revenue, which is money earned from selling goods. Costs and revenue are opposite sides of the income statement, and these costs are not even on it yet. Understanding cost classification is really about understanding timing. Product costs and period costs take very different journeys through the financial statements, and that difference is what determines when they affect your reported profit. A product cost makes 3 stops. First, it enters inventory as an asset on the balance sheet. Second, the sale is the trigger that releases it. Third, it lands on the income statement as cost of goods sold, matched against the revenue from that same sale. Direct materials, direct labor, and manufacturing overhead all travel the long path, sitting in inventory until the product sells. A period cost like advertising skips inventory entirely and goes straight to the income statement the moment it is incurred. A bakery spending $2,000 on flour splits that cost based on what sells. Half the bread sold means about $1,000 becomes cost of goods sold, while the rest waits in inventory. But the $500 newspaper ad is expensed in full in June. It never touches inventory at all. The entire reason this classification matters is timing. A product cost is never an expense, simply because you paid for it. It waits in inventory and only becomes an expense when the product is sold. Keeping that path clear prevents the most common mistakes in measuring profit. Question 45. A factory reports direct materials of $8,000, direct labor of $5,000, and manufacturing overhead of $4,000 for a production run. What is the prime cost? Your options are $7,000, B $13,000, C $9,000, D $8,000. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B, $13,000. B is correct because prime cost equals direct materials plus direct labor, the directly traceable inputs to the product. That is $8,000 plus $5,000, which equals 13,000 days. A is wrong because the figure $17,000 is the total product cost, which adds all 3 components including the $4,000 of manufacturing overhead. Prime cost excludes overhead. C is wrong because the figure $9,000 is the conversion cost, direct labor plus manufacturing overhead, not prime cost. Conversion cost excludes direct materials while prime cost includes it. D is wrong because the figure $8,000 is only the direct materials and leaves out direct labor, which prime cost must include. Prime cost combines both direct materials and direct labor. Prime cost is one of 2 standard ways to combine product cost components that exams frequently test. Understanding exactly what it includes and what it deliberately leaves out is the key to getting these questions right. Prime cost equals direct materials plus direct labor. Both are direct costs, meaning each can be conveniently traced to a specific unit of product. Manufacturing overhead is intentionally excluded because it is an indirect cost. In a typical example with direct materials of 8,000, direct labor of 5,000, and overhead of 4,000, prime cost is 13,000. Watch out for 3 tempting wrong answers: total product cost of 17,000, direct materials alone at 8,000, and conversion cost, labor plus overhead, at 9,000. Notice how the same 3 components can be grouped 2 different ways. Prime cost brackets the 2 direct costs together, while conversion cost brackets labor with overhead. Total product cost spans all 3. Prime cost is specifically and only direct materials plus direct labor, because raw materials are a direct materials component of prime cost. Any increase in raw material prices flows straight into prime cost. Overhead items like utilities or equipment rent are unaffected. This direct relationship is why managers use prime cost to track and control the most traceable production inputs. Question 46. A bakery experiences a 5% increase in the price of its raw materials. Which cost grouping does this increase directly raise and which does it leave unchanged? Your options are: A. It raises conversion cost and leaves prime cost unchanged. B. It raises both prime cost and conversion cost equally. C. It raises prime cost and leaves conversion cost unchanged. D. It raises period cost and leaves product cost unchanged. Which would you go with? Lock it in before the reveal. The correct answer is C. It raises prime cost and leaves conversion cost unchanged. C is correct because raw materials are direct materials, a component of prime cost. So a price increase flows straight into prime cost. Conversion cost is direct labor plus manufacturing overhead and contains no raw materials, so it is unchanged. A is wrong because conversion cost is direct labor plus manufacturing overhead, neither of which is raw materials. So a materials price increase does not raise it. Prime cost is the grouping that contains direct materials. B is wrong because a raw material price increase touches only the direct materials component, which sits in prime cost, not in conversion cost. The 2 groupings are not affected equally since conversion cost has no raw materials. D is wrong because raw materials are a product cost, specifically direct materials, not a period cost such as advertising or administrative salaries. The increase raises a product cost grouping, namely prime cost. Now that we've worked through the question, let's build a clear picture of conversion cost and how it relates to prime cost, and why direct labor sits inside both. Conversion cost equals direct labor plus manufacturing overhead. Think of it as everything that does the transforming, the labor, the machines, the factory utilities, but explicitly excluding raw materials themselves. Notice that direct labor appears in both grouping. That overlap is intentional. Direct materials is prime cost only. Manufacturing overhead is conversion cost only. And direct labor is the shared middle piece connecting them. Using a furniture batch as an example, prime cost is 16,000. Conversion cost is 10,000. But together they exceed the 20,000 total product cost because the 6,000 direct labor is counted twice, once in each grouping. When raw material prices rise, prime cost increases because it contains direct materials. Conversion cost stays completely untouched. It holds only direct labor and overhead, so materials price change simply cannot reach it. Question 47. The flour a bakery uses costs the same amount for each loaf, and the more loaves it bakes, the more total flour cost it incurs. How does a variable cost behave in total and per unit? Your options are: A. It is constant in total and varies per unit. B. It is constant both in total and per unit. C. It varies both in total and per unit. D. It varies in total in proportion to activity and stays constant per unit. Don't overthink it. Which one feels right? The correct answer is D. It varies in total in proportion to activity and stays constant per unit. D is correct because a variable cost changes in total in direct proportion to activity while remaining constant per unit. Each loaf uses the same amount of flour, so the per unit cost is constant, while baking more loaves raises the total flour cost proportionally. A is wrong because this describes a fixed cost which is constant in total but varies per unit. A variable cost is the opposite, varying in total and staying constant per unit. B is wrong because a cost that is constant both in total and per unit does not match any of the three behaviors as activity changes. A variable cost total clearly rises with output. C is wrong because a variable cost does not vary per unit. The per unit amount stays constant while only the total changes. Saying both vary misstates its behavior. Cost behavior describes how a cost reacts when a business does more or less. More units baked, more miles driven. Understanding this is the foundation of budgeting and break-even analysis. There are exactly three cost behaviors: variable, fixed, and mixed. A variable cost has two sides. In total, it rises and falls in direct proportion to activity. Per unit, it stays perfectly constant. Each individual unit costs exactly the same, whether it's the first or the 1,000th made. A bakery's flour cost makes this concrete. At 50 cents per loaf, the total cost climbs in a straight line from zero. 100 loaves cost $50. 1,000 loaves cost $500. Meanwhile, the per unit graph is a flat horizontal line because every loaf costs the same 50 cents. The easiest memory hook is the mirror image contrast. For variable costs, the total varies while the per unit stays the same. For fixed costs, it is exactly the opposite. The total stays the same while the per unit changes. Holding these two side by side is the most reliable way to keep them straight. All of this holds within the relevant range, the band of normal activity where these straight line assumptions are accurate. Within that range, variable costs are treated as perfectly proportional, making cost prediction reliable for the levels a business actually operates at. Question 48. A bakery's rent is $6,000 per month and stays the same in total no matter how many loaves it bakes. As the number of loaves baked falls from one month to the next, what happens to the rent cost per loaf? Your options are: A. It rises because the same fixed total is spread over fewer loaves. B. It falls because fewer loaves means less rent. C. It stays exactly the same per loaf. D. That it becomes a variable cost. Got a guess? Lock it in. The correct answer is A. It rises because the same fixed total is spread over fewer loaves. A is correct because average fixed cost per unit varies inversely with activity. So when activity falls, the same fixed total is spread over fewer units and each unit carries more. With fewer loaves baked, the rent per loaf rises. B is wrong because total rent does not fall when fewer loaves are baked, because it is fixed at $6,000 regardless of output. Fewer loaves means each must absorb a larger share, so the per loaf figure rises rather than falls. C is wrong because fixed cost per unit does not stay constant, only the total stays constant. As volume changes, the per unit amount moves inversely, so it cannot remain the same. D is wrong because rent remains a fixed cost in total, even as the per unit figure changes. It does not become variable. A variable cost would change in total with output, which rent does not. Fixed costs stay constant in total no matter how many units are produced. Rent, insurance, salaried wages, and straight-line depreciation are all examples. But the behavior of fixed cost per unit is where the most important and most frequently misunderstood idea lives. These are the costs of simply being open for business. Whether a bakery bakes 1 loaf or 10,000 loaves, each of these costs stays the same in total. That is what it means for a cost to be fixed. because the same fixed total is divided over more or fewer units. The per unit cost moves inversely with activity. As volume rises, fixed cost per unit falls. As volume falls, fixed cost per unit rises. More loaves means a thinner slice of rent per loaf. Fewer loaves means a thicker slice. Fixed costs also come in two varieties. Committed fixed costs flow from past decisions and cannot be reduced quickly. Think long-term leases or depreciation. Discretionary fixed costs can be adjusted by current management decisions, like advertising or training budgets. Finally, fixed costs are only fixed within the relevant range. Push activity past that range and the cost steps up to a new level. Flat across one band, then jumping when capacity is outgrown. Within each band, the cost is fixed, but crossing into the next band triggers a step up. Question 49. A bakery wants to allocate its overhead precisely by tracking delivery mileage and packaging labor across its retail, wholesale, and delivery operations, charging each product for the activities it actually consumes. Which costing system is it using? Your options are A. Job order costing, B. Process costing, C. Activity-based costing, D. Cash basis costing. Which one is it? Pause the video if you need more time. The correct answer is C. Activity-based costing. C is correct because activity-based costing allocates overhead by the actual activities that drive it, using cost pools and cost drivers such as delivery miles and packaging labor. Charging each product for the activities it actually consumes improves pricing accuracy and reveals true profitability. A is wrong because job order costing traces costs to individual custom or one-of-a-kind jobs, such as a wedding cake, rather than allocating overhead by activity across operations. The scenario is about precise overhead allocation, not tracking unique jobs. B is wrong because process costing averages costs across thousands of identical units flowing through a process, such as granola bars. It does not allocate overhead by specific activities like delivery miles. D is wrong because cash basis costing is not a costing system. The cash basis is a method of timing revenue and expense recognition. It has nothing to do with allocating overhead to products. When a business needs to price its products and measure profitability, it turns to a costing system. There are three main systems, and the right choice depends almost entirely on what the business makes and how it makes it. Job order costing tracks costs to individual jobs. Perfect for custom, one-of-a-kind outputs like tailored suits or construction projects. Process costing spreads costs across a period and divides by units, suiting identical high-volume goods like canned foods or granola bars. Activity-based costing assigns overhead by identifying the activities that actually drive costs, giving the most precise allocation for businesses with diverse products. In activity-based costing, overhead is first sorted into cost pools, one per major activity like packaging or delivery. Each pool has a cost driver, the factor that causes that cost to be incurred. Products are then charged based on how much of each activity they actually consume. So, a delivery of 10 miles costs 5 times more than a delivery of 2 miles. In an exam or real-world scenario, certain trigger words signal which system applies. Words like custom, unique, or tailored point to job order costing. Words like identical, batches, or continuous point to process costing. Phrases referencing overhead allocation by activity, cost driver, or usage measures point to activity-based costing. All three systems ultimately serve the same goal, attaching costs accurately to products so a business can price and evaluate them. The golden rule is simple. Match the costing system to the nature of what you produce and how overhead is best traced to it. Question 50. A bakery sells a pastry for $5. The variable cost per pastry is $2 and monthly fixed costs are $3,000. How many pastries must it sell each month to break even? Your options are A. 600 pastries, B. 1,000 pastries, C. 500 pastries, D. 429 pastries. Take a second. Which answer would you pick? The correct answer is B. 1,000 pastries. B is correct because the contribution margin per unit is the selling price minus the variable cost, which is 5 minus 2, or 3 break-even units equal fixed costs divided by the contribution margin per unit, which is $3,000 divided by 3 T's, or 1,000 pastries. A is wrong because the figure 600 would come from dividing fixed costs by the selling price of $5 rather than by the 3 contribution margin. Break-even must use the contribution margin, which subtracts variable cost first. C is wrong because the figure 1,500 would result from dividing fixed costs by the $2 variable cost instead of the $3 contribution margin. The denominator must be the contribution margin, not the variable cost. D is wrong because the figure 429 comes from dividing fixed costs by the full $7 sum of price and variable cost, which is not how break-even works. The correct denominator is price minus variable cost. Cost volume profit analysis is the planning tool that ties cost behavior together, helping managers model what-if scenarios about pricing, costs, and sales volume. Its most famous application is break-even analysis, finding exactly how many units must be sold before a business starts making a profit. The hero of the analysis is the contribution margin, the amount left from each sale after variable costs are subtracted. It covers fixed costs first, and once those are fully covered, every additional unit contributes pure profit. With a selling price of $5, a variable cost of $2, and fixed costs of $3,000 per month, the contribution margin is $3 per unit. Dividing fixed costs by the contribution margin gives a break-even point of 1,000 pastries. At that quantity, revenue exactly covers all costs and profit is 0. The contribution margin ratio expresses the contribution margin as a fraction of the selling price. A 60% ratio means 60 cents of every sales dollar goes toward fixed costs and then profit. A higher ratio means each sales dollar does more work. Managers actively try to lower the break-even point by decreasing fixed costs or increasing the contribution margin per unit through raising price or cutting variable cost. The same formula extends to target profit planning. Simply add the target profit to fixed costs, then divide by the contribution margin per unit.
You have reached the end of our first question set. For the free complete exam preparation, visit our website, link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.